So now let's talk about taxation of rental income. So there are two main types of income from rental. Okay, so one is the ordinary income from the rental operations. So this is where our rental revenue or gross rental income is higher than all our expenses. Okay, so if I have rent higher than all my expenses, then I have rental income, and that rental income is not going to be taxable. I also have what we call capital gains. So capital gains will be triggered when I sell the property. Okay. So in this case, if I buy a property for $1 million and then I hold it for 5 years, I sell it for 1,500,000, then I have a capital gain of $500,000. Okay. So the difference between my sale price and my cost. For CRA terms, they use adjusted cost, and I will explain what that is later. So the tax that you pay will vary, and it will vary depending on how you hold the rental property. So there are three main ways, or the most popular ways we hold rental property. We can hold it in our name, or jointly with a spouse, or jointly with other partners or other joint venture partners. Okay. We can also hold it in a corporation. Okay, in that case, it's not in our name, it's in a corporate structure, and we can also hold it in a trust. Okay, so these are three most common ways we hold property in Canada, and there's going to be different tax implications for each of these. So we're going to review some of this now. So let's talk about tax implications when you hold properties personally. Okay. So remember I talked about two levels of income. So the income from the rental operation, okay, and the income from capital. So with the income from the rental operation, so here you have your gross rent that you're collecting, you're deducting all your gross or your expenses. Once you take your rent, deduct all your expenses, you have what we call either a rental income or a rental loss. Okay. If you have a rental income, that rental income is added to your income from other sources in your tax return, and that income is going to be taxed at your marginal tax rate. So let's say you have a job with Google or with Royal Bank, and you make $100,000 from your job. Okay. When you file your tax return, you're going to show $100,000 as income from your employment. And if you make additional, let's say $50,000 from your rental operation, then that $50,000 is added to that 100 grand, and then you will now pay taxes on $150,000 at your marginal tax rate. Okay. Now you can use depreciation to reduce your rental income to zero. Okay. So remember earlier I said, well, depreciation is a cost we can deduct for the properties that we have. So let's say you have a property that you spent $1 million to buy. Okay, you spent $1 million to buy the property. So the cost of that property now is $1 million. So you can depreciate that cost and take that as a cost to reduce your rental income. So remember I said we can depreciate 4% each year. Okay, so that means if I have a property that cost me $1 million, I can take a deduction or depreciation of $40,000. Okay, so if I have a net rental income of $50,000, I can take depreciation of $40,000, and now my net rental income will reduce to $10,000, and then that $10,000 I can now use and now add it to my income from my employment. Okay, and if my employment is $100,000, now my total income is going to be $110,000. Now, one of the things to note is that you cannot use depreciation to create a loss from your rental operation. Okay, so let's say, for example, my rental income is only $30,000. Okay, if my rental income is only $30,000, and I know I can depreciate $40,000 on my $1 million house, I cannot take the total $40,000 because my income is only $30,000. So the maximum depreciation I can take will be $30,000 in this example. Okay, so at the end of the day, you can only use depreciation or amortization to bring your net rental to zero. Okay, and this is helpful sometimes, particularly if you're in a high tax bracket, you don't want to increase your income, you don't want to move to the next bracket um, for taxes. Okay, and so for example, so let's say your taxable income from your place of work is $120,000. Okay, if you make $120,000 from your work at Royal Bank or any other employer, your marginal tax rate is going to be approximately 37%. Okay, so that's your marginal tax rate at that level of income. Now, let's say you have additional rental income, net of your depreciation. Let's say you have additional rental income of $50,000. Now, that rental income will move your total income from 120 to now $170,000. And because of that, your marginal tax rate will also increase from 37% to 41%. Okay, so now you end up in a position where you're paying more and more tax. So remember, with marginal taxes, you're only paying tax, the high tax rate on the marginal increase of that income. Okay, now with rental losses, if you have rental losses excluding depreciation, now the rental loss can actually be used to reduce your income from other sources. Okay, so let's say in this example, my rental loss was $50,000. Okay, so in this case, I have my rent, my gross rental income. I deduct all my expenses, excluding my depreciation. If I deduct all my expenses, I have a negative or a loss of $50,000. Okay, so in this case, if my income from my place of work is 120 and I have a loss of $50,000, then my total income for tax purposes will now reduce to $70,000. Okay, because now I can use that loss to reduce my income from work, and once it is reduced, then my marginal tax rate will also reduce from 37% to maybe 30 or low 30s or high 20s. Okay, and that is how the tax will work when you hold property personally. Now, these are the personal tax rates. Okay, and these are the 2023 combined Ontario and federal tax rates. Okay, so let's say you have an income of between 49,000 and 53,000. Okay, you're only going to be paying 24% approximately on your income. Now, if your income goes up to, let's say, $60,000, now your marginal tax rates will now increase from 24 to 29.65. Okay, and that increase in tax will now be applied to the difference. So let me give you an example here. So let's say your income is $60,000. Okay, if your income is $60,000, you're going to pay 20% on the first $49,231. Okay, and then you pay 24% on the next dollar from 49,000 to 53,000. And then you pay 29% on any income higher than 53,000 up to the 60,000. So on about 6,700, you're going to pay 29% interest tax on that amount. Okay, so it's marginal tax rate, and that's how our tax system works. So for planning, we try to reduce our marginal tax rate so that we don't get to the high tax bracket. Now with capital gains, as I mentioned earlier, capital gains will only be triggered on the sale of the property. Okay, so once you sell the property, you will now have capital gains taxes to pay. Okay, and this will happen when the net proceeds from the sale exceeds the adjusted cost base. Okay, and if you have that situation, then now you have a capital gain to pay. Okay, So net proceeds simply means if I sell my property for $1 million and I pay a commission of $50,000, then my net proceeds is not 1 million, it is $950,000 because I've paid $50,000 as commission. Okay, and let's say I pay another $10,000 to lawyers to close the transaction, then my net proceeds will reduce by another $10,000. Okay, so that's your net proceeds. Now, your adjusted cost base is typically how much you paid to buy the property, then any other additional cost you incurred, capital cost you incurred for the property. So let's say I bought the property for $500,000 and then I spent maybe 2-3 years down the road, I spent another $100,000 to renovate the property. Okay, then another 2-3 years, I spent another $50,000 to make some other renovation, expansion to add another unit. Now, my total cost is not just the $500,000 I paid when I closed the property. I'm gonna add the $100,000 I spent 2 years after that. I'll add the other additional $50,000 I spent. Okay, so now my adjusted cost base for that property is not $500,000, it is $650,000. Okay, and so when I take the difference between my net proceeds and my adjusted cost base, that difference would now be my capital gains. And capital gains um, is not taxable at 50% of capital gain. So your taxable capital gain will now be 50%. Okay, and this rate is gone up based on the proposal from the budget this year. Again, we still have to wait for it to go into law, but right now, as it sits, it is 50% of your gain that will be included in your tax return. Okay, so if I have a so let's say I bought a property for $600,000. No, so let's say I bought a property for $500,000 and I sold it for $600,000. Now I have a gain of $100,000. Okay, so that's 600 minus $500,000 is $100,000. Now that gain at 50%, 50% of 100 is $50,000. So I'm now going to take $50,000. I'll add to my personal income from work, and then I'm going to be taxed on that at my marginal tax rate. Okay, and that is how the income will be taxed. Now there's something that's called recapture tax. Okay, now remember, if you're taking depreciation on your property, let's say you took depreciation over the years and the total depreciation you took on your property was $10,000. You know how we could deduct 4% of the cost of the property each year. Now, if we do those deductions, what those deductions do, essentially, they allow us to defer the taxes until we sell the property. Now, once you sell the property, the government or CRA will try to recapture all those deductions you took. And so you will not pay tax on that recapture. Okay, so if I took a total of $10,000 deductions as amortization, when I sell the property, I'll take that 10,000, I will add to my income, and that 10,000 is going to be taxed again at my marginal tax rate. Sometimes it's possible to sell a property and incur a capital loss. Okay, so in this case, you sold it for less than what you paid for it. If that is the case, then the capital loss can only be deducted against other capital gains. Okay, if you don't have any capital gains, then bad luck, you can't deduct it. The good thing though is that those capital losses can be carried forward indefinitely. They can also be carried backwards for the last 3 years. Okay, so if you had capital gains 2 years ago, 3 years ago, you can now go back and apply that loss to the capital gains you had 2-3 years ago, and that would generate a refund for you. Now, on the personal side, these are some factors that can impact your ability to get capital gains. So remember, capital gains gives you a fairly um, a better tax treatment compared to just regular taxes that we pay on our income. And the reason for that is because we are not paying taxes on the entire gain. Okay. In this example, in the current market, we are only paying taxes on 50% of the gain. Once this inclusion rate goes up to 66.67%, once that passes into law, we're going to be paying capital gains at about 67% of the gain. Okay, so the fact that we're not paying capital gains on the entire gain, we're not sorry, the fact that we're not paying taxes on the entire gain is a good thing, and that makes capital gains taxes one of the desirable taxes to pay. Okay, so these are some of the factors that can impact your ability to get capital gains. Okay, one is assignment sale. Okay, so if you're in a market where you're buying pre-construction and then you're selling them before you close on them, then that does not qualify as a capital gains treatment. Okay, so if I buy a property, let's say I buy a property for $300,000. Okay, and I hold it, and then I assign it before I close. And and at the time I'm assigning it is $400,000. Okay, so in that case I have $100,000 gain. Now that gain I'm gonna pay taxes on 100% of that gain. Okay, so the tax law will not allow you to to deduct 50% or to only pay taxes on 50% of the gain. So you're going to pay taxes on 100% of the gain. Okay, so that's why if you're doing assignment sales, you have to be really, really careful to make sure that you factor in the taxes because those taxes will have to be paid. And again, you're going to pay taxes on 100% of the gain. Um, So for those of you that are aware, there was a new law that was passed into law recently. It's called the anti-flipping law. Okay, so what that means is if you buy a property, close on it, and you hold it for less than 1 year, then if you sell it, that sale will no longer qualify for capital gains treatment. Okay, so if I buy a property for $500,000 and if I sell it within a year, and maybe I sell it for $200,000. Sorry, I buy for 500. I sell it for $700,000. So I have a $200,000 gain. Because I didn't hold that property for more than 1 year, I will now pay taxes on the entire $200,000. If you hold it for more than 1 year, you're not going to pay taxes on the entire 200. You're only paying taxes on half of that, on 50% of that. Okay, so that's something to have in mind. But again, we know that circumstances can change. Okay, if your circumstances change, let's say your original intention was to hold the property, to close it, to rent it and hold it for 5, 6 years, and maybe some circumstances change within your life, then you have to be able to prove to CRA the reason why you're either signing or flipping this property, and then you may be able to have a case to get the inclusion rate of at 50% for tax purposes. Okay, so again, that's something to have at the back of your mind. So now let's shift gear and go to a corporation. Okay, so tax implication with a corporation. Now, the Tax Act is designed in such a way that the tax implication when you hold property personally is similar to the tax implication when you hold a property in a corporation. Okay, so the government does not want this idea where people are using corporation to sort of avoid paying taxes or to lower their taxes. Okay, but that thing is not perfect. So we call it the corporate integration, but it's not always perfect. But that's the intention. Okay, so with rental income, if you have rental income from operations and you have rental income held in a corporation, rental income held in a corporation is considered specified investment income. Okay, so specified investment income is known as an inactive income, and it is taxed at a fairly high rate within a corporation, approximately at 50%. Okay, now this rate can be reduced to approximately 20% when you pay a dividend to the shareholders. Okay, and that's what they call it's through this mechanism called the RDTOH, or what they call the refundable dividend tax on hand. Okay, now you have to pay the dividends to sort of lower the taxes. And the reason why that is in place is because when you pay dividends, the person receiving the dividend will also include that in their personal tax return. And so this mechanism is to avoid double taxation. Now, the rental income from a rental operation can be considered active. Okay. And there are a couple of things you need to do for it to be considered active. Now, active income in a corporation is taxed at a much lower tax rate, approximately 12%. Okay, and so that's why people use corporation and try to generate active income. Now, with rental operation, for your rental operation to be considered, or your rental income in your corporation, for that rental income to be considered active income, then the corporation needs to employ at least 5 full-time employees. And so typically that's something you will see in a big rental operation, a big company. Now with small landlords like us, that we own just a few properties, because a few properties is not going to be sufficient for you to sustain 5 full-time employees. Alternatively, the income may be considered active if it is an income from an associated company, and that income from that associated company was deducted to determine the associated company's income from an active business. So for example, so let's say I have a holding corporation, and my holding corporation owns my real estate, and then I have my regular business. Okay, if I'm renting from my holding company, because I'm running a regular active business, that expense that I'm paying for rent is deducted as part of my active business. And so for my holding company, that income that I'm getting will not be considered active income and will be taxed at a low rate of 12%. Okay, so those are the two main criteria that will enable you to convert a specified investment income, which is considered inactive in a rental corporation, to an active income in a corporation. Now, capital gains treatment is again similar to personal to personal taxes. However, with the new tax rates, with the new capital gains tax rates, inclusion rate is going to be 66.67% on every dollar of gain. So remember, with this new proposal for tax rates, if you hold the property personally, then you're still going to get the benefits for the first $250,000 of your gain. Yeah, the inclusion rate for that is going to be 50%. Then any gain exceeding $250,000, the inclusion rate will not be higher at 66.67%. And so now, if this goes into law, then it may even be better to hold properties personally in your personal name, or to hold them in a joint venture structure, or limited partnership structure. Okay, just to keep your tax rates low. Now, with a corporation, the portion that is not taxable is held in a notional account called capital dividend account. Okay, and that amount can be paid out to the shareholders on a tax-free basis. Okay, so remember, when you have a corporation, it's always a challenge to pull money out from the corporation. Unlike personally, if I hold my property personally, if I sell it, the money just stays in my name. I'm just going to pay taxes at 50% of the gain. But in a corporation, it's different because the money goes into a corporate account, goes into a corporation, and so the portion that is not taxable goes into this account called capital dividend account. And so every corporation should be tracking this capital dividend account, because now you have to fill a couple of forms to CRA to now pay that capital dividends out, and typically that will be paid out tax-free. Now, there are some differences between corporation and personal, okay? Even though the government is trying to make the tax implication similar, there are some differences. So with a corporation, there's really no marginal tax rates. similar to what you find in the personal tax system. And so you just have active income that is taxed at a lower rate. You have specified investment income that is taxed at a higher rate. And you can also still benefit from tax deferral within a corporation. Okay, assuming that some of your income is active. Okay, so the fact that you pay taxes at a low rate within the corporation and you keep the money within the corporation, then yes, you're deferring those taxes, and then you can now use those dollars to continue to invest inside the corporation. So that's the benefit. Now, what are some tax planning considerations with corporation? Now, if you're doing assignment sales, if you're flipping real estate, then it's best to use a corporate structure to do that. And this is because that business is going to be considered active business, and you're paying taxes at 12%, rather than doing it in your personal name. Because doing it in your personal name, you may be paying taxes at a top marginal tax rate, yeah, anywhere from 40 to 50%. Okay. With the corporate structure, you can still benefit from tax deferral inside the corporation. Corporate structure is always going to be a best structure to use, particularly if you run a business from a property that you own. Okay, you will save taxes, you will mitigate risk, and finally, is a lot easier to transition properties that are held in a corporation to the next generation using an estate freeze. And by doing that, you minimize taxes, you defer taxes, and then that way you can, on the sale of the property, you can split the income and pay very low capital gains taxes than if you held it in your personal name. The final structure is trust. Okay, so typically a family trust is a legal entity that you can use to hold assets for the family. And there are some advantages that come with this. It will help you protect your assets from creditors, from lawsuits, and from other legal issues that may come as a result of running the rental operation. This is an advanced strategy, right? It's an advanced strategy to consider if you have significant gains in your assets. Okay, and so this is not something I would recommend to everyone to do because it's expensive to set up, it's expensive to maintain every year. But again, it's very, very good strategy to consider once you have some significant gains in your properties and you're looking to transfer those properties tax-free to your kids or to the next generation. And so with a trust, you can continue to have this property stay in the family for much longer, and then the taxes will be paid much later down the road. Okay. The trust itself is not taxed, okay, because the trust is a flow-through structure, okay. So all the income in the trust will eventually be distributed to the beneficiaries of the trust. And now, if beneficiaries are kids and grandkids, they may be in different tax brackets, and so at the end of the day, some may pay taxes, some may never pay taxes, and so it's a good way to distribute income